Welcome to this week's episode of Jonathan on Money. This is episode number 168. This show will drop right after the July 4th weekend. And for those who may not know, which I imagine is many listeners who are, I don't know personally, July 4th is not only my brother Dovi's birthday. Happy birthday, Dovi. It is also one of my favorite holidays of the year. Thanksgiving still has the edge, but July 4th is not far behind. Every year, my family has the tradition of leaving to the beach at 8:30 a.m., spending 4 to 5 hours at the beach, grabbing ice cream at the local shop nearby, having a stickle lunch, and then going home for a barbecue. We plan to do the same thing this year, even though the celebration will happen primarily on Friday, July 3rd. And here's the deal with July 4th. There's a lot of fetching about crowds, traffic, and so forth. The reality is, if you're willing to get your day started a bit earlier, you can sidestep most of the chaos, lines, and unpleasantness. This is certainly similar to financial planning. Folks that put in the effort early on often have less stress and more pleasantness down the road since it's less of a struggle to achieve their financial goals. And I'm going to share more on July 4th and my talking points given the country's special 250th birthday celebration. In other news, don't forget to get my book, D is for Diversification, the ABCs of Personal Finance, which is now available on Amazon or at jonathanonmoney.com. And buying this book is really a wonderful way to support this podcast. And finally, before jumping into this week's episode, I'd like to share my upcoming live fall webinar series will be released in a few weeks. If you or a friend would like to be notified of my upcoming series, you can either go to parkbridgewealth.com/webinars and can register to be on my webinar distribution list, or email me directly with the word webinar on the subject in the subject line, and you will be added to the list. Okay, now for today's agenda. My talking points this week will discuss America at 250, the Jewish financiers who helped build a nation. Our quote this week is from JP Morgan on the mistake of betting against America. I'll spend the last half of the episode answering listener questions, including how much to spend on a first date. And finally, we'll end with an actual idea to implement your investing life, where we'll discuss why having a barbecue and apple pie on July 4th weekend is actually a good investment. With that, let's jump into this week's talking points. So, as America marks 250 years since its founding, I'd like to focus my talking points today on a story rarely told with as much prominence as it deserves, which is the central role Jewish Americans have played in building the nation's financial architecture. From the revolutionary Philadelphia to modern Wall Street, Jewish financiers have not merely participated in the American economic story at pivotal moments, they have written entire chapters of it. And today, I'm not going to share a ranking of historical Jewish financiers. After all, choosing one figure per decade necessarily leaves out other towering contributors. It is instead a walk through 250 years of American history told through the people whose vision helped fund the revolution, build railroads, rescue cities from ruin, and construct institutions that still anchor the global economy. It's a record Jewish Americans should listen to with pride. And let's start first in the 1770s, where there was Chaim Salman, the financier of the revolution. The story begins with the revolution itself. As the principal broker to the Continental Congress, Chaim Salman arranged loans, sold bills of exchange, and personally advanced funds to keep the fledgling war effort afloat when its cause seemed nearly lost. He's remembered as the financier of the revolution, a title earned through real risk-taking at the birth of the Republic, while he also stood as a pillar of Philadelphia's Jewish community. In the 1780s, there was Benjamin Nones, the Patriot merchant. He was a Revolutionary War veteran who became one of Philadelphia's leading merchants. Benjamin Nones represented something new, a Jew who could simultaneously be a soldier, a businessman, and a civic leader in the new republic, helping integrate Jewish commercial and civic life into America's earliest institution. The 1790s brought Samuel Myers, the builder of New York's foundations. As New York emerged as America's financial center, Samuel Myers stood among its most prominent Jewish merchants, helping develop the trade and capital networks the city needed to become a global commercial hub. The 1800s brought a name many are familiar with, Judah Turow, America's greatest Jewish philanthropist. Few names are as synonymous with generosity as Judah Turow. He built his fortune in shipping and trade, made a point of never mortgaging properties to acquire new ones, and lived a simple life in a small apartment. I have saved a fortune by strict economy, he said, while others have spent one by their liberal expenditures. A lesson we could take and learn much from today. Turo turned his wealth into one of the greatest philanthropic legacies in American history, funding synagogues, cemeteries, hospitals, civic institutions. From Newport to New Orleans, few financiers in any era have left a more enduring charitable footprint. In the 1810s, there was Joseph Simon, the frontier financier. While much of early Jewish commerce centered on the coast, Joseph Simon helped extend financial networks into Pennsylvania and the western frontier, connecting frontier commerce to established markets and a critical link for America's westward expansion. In the 1820s came Mordecai Manuel Noah, an advocate and builder. Few figures combined finance, journalism, and advocacy quite like Mordecai Manuel Noah, one of the most visible Jewish public figures of his era. Noah engaged in banking, real estate, and commercial ventures that contributed to New York's growth while using his platform to advocate forcefully for Jewish civil rights. His bold vision for Jewish self-determination in America, conceived decades before modern Zionism took shape, reflecting a conviction that the nation's promise of religious liberty should extend fully to Jews. In the 1830s, there was August Belmont, the connector of continents. As the American representative of the Rothschild banking dynasty, August Belmont became one of the most powerful bankers of the 19th century, financing railroads, government debt, and infrastructure that fueled America's expansion while becoming one of the era's most significant political fundraisers. In the 1840s, there was Joseph Seligman, the investment banking pioneer. Joseph Seligman founded J&W Seligman and Company, a powerhouse that financed railroads and major government projects at a critical stage of American industrial development. His public exclusion from New York's Grand Union Hotel became one of the most cited episodes of American anti-Semitism. Yet Seligman responded not with retreat, but with redoubled devotion to Jewish charities and immigrant aid, a lesson that certainly has practical implications in today's increasingly anti-Semitic climate. The 1850s brought Marcus Goldman, the founder of an institution. What began as a modest commercial paper business built by Marcus Goldman would eventually grow into Goldman Sachs, one of the most influential financial institutions in the world. Goldman pioneered new financing methods for growing companies during America's industrial expansion. Then in the 1860s, Mayor Lehman came onto the scene where he transformed business from cotton to capital. Mayor Lehman helped transform cotton brokerage into Lehman Brothers, a financial powerhouse that would play a defining role in financing industrial America after the Civil War, becoming one of Wall Street's most important institutions for more than a century. The 1870s brought Jacob Schiff, who was America's most influential banker at the time. Few individuals in American financial history wielded more influence than Jacob Schiff. As the leading force behind Kuhn, Loeb and Company, Schiff financed the railroads, industry, and infrastructure that powered America before World War I and famously financed Japan during the Russo-Japanese War, altering the course of global geopolitics. He matched his financial power with extraordinary generosity, funding Jewish education, hospitals, and relief for persecuted Jews across Eastern Europe. In the 1880s, there was Jules Bach, who opened global markets. Jules Bach built J.S. Bach and Company into one of Wall Street's largest brokerage firms at the time, with expertise in mining, commodities, and international markets. At a time when investing abroad remained rare, Bach expanded American investors' access to global opportunity. The firm he would build would go on to merge and evolve through several names over the following decades, eventually becoming part of what is today Wells Fargo Advisors, a testament to the staying power of the institution he founded. In the 1890s, brought Otto Herman Kahn, who impacted finance and culture as a leading partner at Kunlum. Otto Herman Kahn helped reorganize, I should say, major American railroads, making him one of the most prominent financiers of his generation. Equally renowned as a patron of the arts, Kahn used his stature to promote greater Jewish acceptance within elite American society. In the 1900s, there was Paul Warburg, who was the architect of the Federal Reserve. Every time the Federal Reserve sets interest rates today, it exercised authority that traces back to Paul Warburg, widely regarded as the intellectual father of the Federal Reserve System. He imported European central banking concepts that modernized American finance after devastating banking panics, an influence still felt more than a century later. During the 1910s, there was Bernard Baruch, who had influence from Wall Street to the White House. Bernard Baruch's career bridged worlds rarely connected, a legendary Wall Street speculator who became a trusted advisor to multiple presidents, directing American industrial mobilization during the First World War. The 1920s was heavily benefited by Julius Rosenwald, who was a retail pioneer and philanthropist. He built Sears Roebuck into the American dominant retailer, essentially the Amazon of its day. He donated tens of millions to causes nationwide, funding nearly 5,000 schools for black children across segregated South, alongside Booker T. Washington, transforming American philanthropy and education. The 1930s was influenced by Sidney Weinberg, known as Mr. Wall Street. When the Depression nearly destroyed Goldman Sachs, Sidney Weinberg rescued and rebuilt it into a Wall Street premier advisory firm, rising from a shoeshine boy into the mailroom and all the way up the corporate ladder to CEO of Goldman Sachs. Corporate leaders and presidents alike sought his counsel, earning him the name Mr. Wall Street. Weinberg also played a vital role helping Jewish refugees escape Nazi Europe. During the 1940s, a man named Andre Mayer helped invent modern deal making. At Lazard, Andre Mayer pioneered the modern era of mergers and acquisitions, advising corporations on the kind of transformational transactions that became the blueprint of investment banking as we know it today, while also dedicating himself to assisting European Jewish refugees after World War II. Throughout the 1950s, Arthur Burns helped shape economic policy. Arthur Burns brought his influence to bear on the highest levels of American economic policy, serving as chairman of the Council of Economic Advisors and later as Federal Reserve Chair. The 1960s was heavily impacted by Gus Levy, who was a pioneer of modern trading. Gus Levy rose from running Goldman Sachs' one-man trading desk to becoming senior partner at the firm, transforming Wall Street trading along the way. He pioneered the practice of block trading, executing what was at the time the largest such trade in history, and built the risk arbitrage business that would later become central to modern investment banking. Levy was also one of the era's great Jewish philanthropic fundraisers, raising enormous sums for Jewish charitable and communal causes in New York. During the 1970s, Felix Rohatyn became known as the banker who saved New York. Felix Rohatyn's story is among the most remarkable on the list. A Holocaust survivor, Rohatyn engineered New York City's rescue from near bankruptcy in 1975, becoming America's foremost restructuring banker through his work at Lazard, proof that financial expertise can stabilize not just companies but entire governments. The 1980s was dominated by Michael Milken, who was the creator of new capital markets. Michael Milken's innovation effectively created modern high-yield bond market, opening access to capital for thousands of entrepreneurial companies that might never have secured financing otherwise. Despite the legal controversies that followed, those structural changes Milken brought to corporate finance proved enduring, and he subsequently became one of the most significant philanthropic supporters of medical research and education in the country. During the 1990s, Sandy Weill became the builder of the modern conglomerate. Sandy Weill built Citigroup through a series of landmark acquisitions that reshaped the structure of global banking. His financial supermarket model, combining banking, brokerage, insurance, and asset management under one roof, redefined what a modern financial institution could be. The 2000s brought Steven Schwartzman, who institutionalized a new asset class. Steven Schwartzman built Blackstone into the largest alternative asset manager in the world, helping institutionalize private equity, private credit, and alternative investing as core pillars of global finance. His influence has reshaped how pension funds, endowments, and sovereign wealth funds invest trillions of dollars. The 1910s was heavily impacted by Larry Fink, who is essentially the steward of the world's capital. Under Larry Fink's leadership, BlackRock grew into the largest asset manager on earth, overseeing more than $6 trillion by the end of the decade. Beyond the firm's sheer scale, Fink helped democratize investing itself, expanding access to low-cost mutual funds, ETFs, and other investment vehicles that brought Wall Street within reach of millions of everyday Americans who previously had little entry point into the market. And finally, during the 2020s, Janet Yellen became a historic first. Janet Yellen made history as the first woman to chair the Federal Reserve and later became the first woman to serve as U.S. Treasury Secretary. In these roles, she has guided the country's response to inflation, banking sector stress, and post-pandemic economic challenges, directing both monetary and fiscal policy as one of the most consequential moments in modern American history. I know that was a long list, but I wanted to emphasize how the impact of Jewish financiers in the United States since its founding 250 years ago is a legacy to be proud of. Taken together, these 25 lives tell a remarkable story spanning 2.5 centuries, immigrants and children of immigrants who time and time again found themselves at the center of America's most important financial moments, financing its revolution, founding its great investment banks, architecting its central capital, rescuing the largest city, and stewarding trillions of dollars of the world's capital. It's a story made more remarkable by the fact that so many of these figures achieved success while facing real anti-Semitism, from Joseph Seligman's public humiliation at a New York hotel to the broader prejudices Jewish bankers regularly confronted on Wall Street. And yet, decade after decade, they not only persevered, but excelled, all while turning back towards their own community, funding synagogues, hospitals, rescuing refugees, and supporting Jewish causes around the world. As American Jews navigate a difficult new wave of anti-Semitism, this history offers a perspective and pride. The Jewish American story is inseparable from the American financial story itself. Jewish Americans have generation after generation punched far above their weight, and they continue to do so today. Okay, those are the talking points this week. And as a reminder, you could be notified of all my recent articles, webinars, and all the work I put out by subscribing to my free monthly newsletter at parkbridgewealth.com/newsletter. This week's quote is from JP Morgan. For those who don't know, JP Morgan was one of the most influential financiers in American history, known for stabilizing markets during crises, organizing major railroads, and shaping the foundation of modern banking. His disciplined approach, enormous influence, and ability to coordinate capital made him a defining figure of the Gilded Age. He also had a notable and sometimes tense relationship with Jacob Schiff, the head of Kuhn Loeb and Company, who I mentioned earlier. While Morgan dominated industrial finance, Schiff became a powerful force in railroad and international finance, often backing projects that directly competed with Morgan's interests. Their rivalry over control over major railroads, especially the Northern Pacific, became one of the most famous financial battles of the era, illustrating how two titans and with very different backgrounds and worldviews helped shape American capitalism. And Morgan once said, "The man who's a bear on the future of the United States will always go broke." The message here is simple. Pessimists do not build great nations, great companies, or great fortunes. While crises and downturns are inevitable, the long arc of American innovation and productivity has consistently rewarded long-term optimism. For investors, the quote underscores three core principles. One, markets trend upward over time. Two, betting against that progress carries outsized risk. And three, faith in economic resilience is often the most rational stance. It is a reminder that compounding works only for those who stayed invested, avoid emotional pessimism, and trust the broader trajectory of growth. This is an especially important message for America's 250th birthday. Stay positive on America despite its challenges. Those who do so will always succeed. Okay, now let's jump into this week's financial questions. And if you do have a question, feel free to submit it to me, and it may be answered in a future episode. Okay, first question. What is a sensible amount to spend on a date? I went out with some business partners to a restaurant, and the bill was astronomical. Yet I saw tons of dates there. They must have dropped hundreds of dollars. What are your thoughts? So, my first thought is perhaps it wasn't a first date. My next thought is who the heck wants to sit on a 2 hour meal at a 2 hour meal with someone they never met before or met only once and may not like? My third thought is that it was a good thing that I was hungry when I went out with Lauren for the first time because I took her to dinner. My typical first date was coffee. She doesn't drink coffee, so there may not have been a second date. This is called hashgacha pratis. It refers to the belief in Jewish theology that God is actively and intimately involved in the details of all creation, not just as a distant creator, but as a guiding force in every individual's life. This concept suggests that nothing happens by mere chance. Even the smallest events are guided by divine purpose. But back to your question, going to a place like Barnea or Tabernacle may be a bit extreme for a first date. Dropping $300 on someone you may not want to see again, it's mamish imprudent. If it's a 10th date and you want to secure this meidel to build a bayis neman together, then a fancy dining experience is certainly a worthwhile experience. The logic is simple. Drop several $100s, but then build a totally geschmack bayis neman ad me'aves from shana, and that's the best ROI or return on investment that anyone can ask for. If it is a first date, I would suggest going to a more moderately priced place like Mr. Broadway. That's what I did, and it proved to be an effective strategy. Alternatively, you can go axe throwing because that's a normal activity for a Beis Yaakov girl looking for a shidduch. Spend 20 to 30 bucks, and each person can catch a glimpse of how the other party would act in an Armageddon scenario where the world is being destroyed, no guns are available, and all you have are axes, knives, and machetes to protect you. Pretty practical way to evaluate the real world skills of a potential mate. Will AI replace financial advisors? I feel like this question has been asked several times over the past few weeks, but worth repeating. No, just like robo advisors and online trading tools, neither of these technologies was able to supplant financial advisors despite all the claims and predictions. AI will not be able to either will not be able to either. AI is a great tool that I use in my day-to-day businesses. However, it's just one tool out of many that are necessary to do this work. One example of the limitations of AI are the fact that not every aspect of financial planning and investing are easily quantifiable. Some are determined through experience, emotional intelligence, and social skills, and oftentimes I have to pick up on the body language of the things that are not said in order to offer a practical solution to a family's needs. There are many others, but this is just one example. The advisors who are positioned to excel in the world of AI are the ones who understand how to harness it and integrate it into their own practice. Next question. How do I calculate my dad's RMD? He's not on top of this stuff anymore, so I need to figure it out since he doesn't work with a financial advisor. His IRA money is at a few different firms. Thanks. To calculate your dad's required minimum distribution RMDs, his entire retirement account balance across all accounts as of December 31st, 2025, i.e., the previous year, by a life expectancy factor from the IRS Uniform Lifetime Table. It makes sense to consolidate his various IRAs into one single IRA at one institution in order to simplify your life. There is no benefit, literally zero, of having a variety of the same accounts at many different institutions. Unless your goal is to complicate your life and make your dad's finances a total mess, then consider consolidating. If you want to further simplify and organize your dad's finances, then ask a financial advisor to help you. They will be able to help you consolidate the accounts, invest the funds sensibly, minimize the risk, and will proactively reach out about processing the RMDs every year. RMD should be a 2-minute task. For some investors, it becomes a life altering decision and a multi month project as the clients try to figure out their numbers and deliberate where they want to send their funds. Don't overcomplicate your life. Keep the funds organized. Decide if you want the funds to support your dad or support charity. If the former, then move it to his checking account or investment account. And if the latter, determine two charities you want to send the funds to. In the end, just do it, move on with life. There are enough things to make life stressful. Calculating your RMD should not be one of them. Next question. I like the idea of investing in real estate because it's an investment I can see and touch. Feels more secure to me. What are some of the risks of being a landlord that I may be overlooking? I also feel like I go over the risk of investing in real estate often. They're always worth repeating because people never actually learn their lesson. Here are some considerations that will cause you to have worse returns than you expect and cause stress to your life. The main risk of real estate investing include illiquidity concerns, as it can be difficult to sell property quickly. There are also financing and interest rate risks, which affect borrowing costs. Other risks include unexpected maintenance and repair costs, potential tenant vacancies, legal and regulatory issues, and location-specific factors like crime rates and proximity to amenities. By the way, you can touch the products that stocks make too, like your underwear and glasses are both made by companies you can invest in. You can even still invest in real estate publicly, just do it through publicly traded REITs. The difference is you don't need to deal with all the headaches I mentioned, and you have the benefit of more broad diversification in order to manage risk. And by the way, you know what else is a real life practical risk? Some brilliant Marxist politician with a resume less impressive than a high school senior who decides to freeze rent, tax the hell out of people and companies that create jobs, restrict new building projects except for the homeless who can't pay rent, and defunding the police department so the town in which you own property turns into an apocalyptic, cesspool of drugs and violence. Unless you are in the real estate business and are not pursuing it as a side hustle, then stick to publicly traded stocks or don't. You could also learn the highway. Okay, my daughter entered the financial advisory training program at a large firm. She spends a lot of time handling menial tasks. Is this standard practice? If so, when does the work get more interesting? One of the realities of any career is spending a ton of time on nonsense activities that are beneath you. The truth is, they are not beneath you because everyone has to do them. You are just overqualified for doing them. It happens to everyone unless your uncle is hiring you. Do you know how much of my day is spent dealing with mind-numbingly stupid compliance nourishkeit? Or how much of my time is spent following up with people, reminding them to sign forms that they were supposed to sign days or weeks ago? When I worked in the corporate world, it was even more silliness. Some jerk middle manager who got his job because his wife is friends with the CEO, and now he wants to have a check-in, quote unquote, meeting every Monday so he can feel like he's doing something productive with his life. He then gives me questions to fill out and send back to track my progress, but in reality, he's just looking for a way to prove to his boss that he's doing valuable work. Guess what, brah? That's corporate America. At the first place I worked, the mailroom guy told me I was required to answer his phone so he didn't have to. This was not in the job description, but I did it, as did everyone else in the training program of this prestigious financial institution, until he got reprimanded by a mid-level manager that he needs to answer his own phones. Every job, no matter what you do, requires menial or boring tasks. Doctors complain to me about how much paperwork they need to fill out. Lawyers spend tons of time on billing, correcting documents, and partner meetings. The bottom line is this: a big part of any job involves dealing with nonsense. It's good training since it teaches you how to deal with nonsense in life, and you will need to deal with a lot of nonsense and stupid people in the real world. In wealth management, the best way to move away from the boring and tedious work is to bring in new clients. If you are a rainmaker, then you can focus on whatever you want until compliance tells you to fill out the new form or attend a mandatory harassment training session. May your daughter be zoche to quickly understand that this is the way the world works, to deal with it with a positive attitude, which will ultimately allow her to have a long and lucrative career in wealth management. Okay, that's it for financial questions this week. And by the way, if you have a more involved personal finance situation, feel free to reach out directly to me, and perhaps my team and I can help you. The best way to get a hold of me is via email at jonathan@parkbridgewealth.com. And finally, I'd like to end with a timely and actionable idea that listeners can implement to their own financial lives. And today's timely idea on the theme of this week's show is to have a barbecue and eat apple pie on July 4th. And if you missed doing it this year, because I know this episode is going to drop right after that July 4th weekend, I like to plant the seed for next year. Buying an apple pie and hosting a barbecue on the 4th of July can be viewed as a good investment because you're investing in something that doesn't show up on a brokerage statement: relationships, memories, and well being. Financial planning isn't simply about maximizing returns. It's about using money to build a meaningful life. A July 4th barbecue is a relatively inexpensive way to create experiences that strengthen family bonds and friendships. Decades from now, your children are far more likely to remember backyard games, fireworks, and sharing apple pie together than another dollar left in an investment account. Behavioral economists have long found that spending on experiences often produces more lasting happiness than spending on material possessions. There are also an investing lesson hidden in the holiday itself. Independence Day celebrates nearly 250 years of American resilience, innovation, and economic growth, which I brought up throughout this episode. Investors who have maintained confidence in the long-term prospects of the United States through wars, recessions, inflations, and market crashes have generally been rewarded. Enjoying a barbecue while owning a diversified portfolio of American businesses is, in a sense, celebrating both the nation's past and participating in its future. And if you're wondering, yes, I can tie any topic back to personal finance, even apple pie and eating meat during a barbecue. Okay, and with that, it's a wrap for this week's show. Any comments or questions, feel free to reach out directly to me via email. I love hearing from my listeners. And finally, the secret to financial success is no secret at all. It's to spend less than you make, invest the difference prudently, and ignore all the noise. See you next time on Jonathan on Money.